Welcome to Views from the North, a Canadian rates and macro podcast. This week, I'm joined by Jeff Oland, one of our Government of Canada bond traders. This week's episode is titled, Spicy Start to the New Year. I'm Ben Reitzes, and you're listening to Views from the North. Each episode, I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macro economy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated. Jeff, welcome back to the show. Appreciate you stepping in last minute here. After a couple of other guests flaked out on me, so you're bailing me out. I appreciate that.
We say to one client in particular, if he's listening to this, just remember who your friends are.
Yes, I do remember who my friends are now, and you're one of them, clearly. Interesting start to the year, mostly due to ridiculous headlines. Before we get to all that fun stuff, Bank of Canada's next week, and I don't think anyone's expecting anything. I'm not expecting anything. The growth backdrop has kind of gone back and forth. And in Q4, if you look at the surprise index on the data, it was really high. And then the calendar turned and it's gone all the other way. So we got like 3 really good job numbers and then the mediocre one at the start of this month. Earlier this week, we got the Business Outlook survey, which was definitely on the soft side, better than it was the prior quarter, but still pretty crappy, to use my official language there. And CPI came in on the soft side, weaker core numbers pretty much across, pretty encouraging, but again, not enough to really move the needle for the bank. So we're kind of stuck where we are. Any thoughts on that? Anything different? Anything to flag on the bank that maybe I'm not quite or didn't cover?
We had one salesperson kind of canvass a bunch of their bigger clients this week, and everybody came back with the same response, which is that nobody has a strong conviction view anyway. I don't know if that means we're setting up for a big move. I do think it means the positioning is not overly dramatic in either direction. We saw, I think, last week, the lowest 30-day rolling range on treasuries in like 50 years. So there just has not been a lot of vol.
That's a long time.
Yeah, it is. And I think it just seems to be that people are roughly figured out where they think things should be. And whatever headline risk we've been kind of getting hasn't been really all that consequential. And in the end, it's just noise. Like there are some people and some people on this floor that will disagree with that. But to me, I don't think it's something you can really make investment decisions around all these different headlines until at least something tangibly changes. So heading into the bank, I have a difficult time seeing the bank hiking rates this year, especially if you think the Fed is going to be cutting rates regardless of who the Fed chair is going to be. So from my mind, I have to say, if I were to pick out a consensus view, it's that the bank isn't done cutting and that we get a few more cuts. People think I have some kind of specific axe to grind against the housing market, which one person messaged me last week and reminded me that in Quebec City, housing prices were up 10 or 15% last year, and that is true. But in Toronto and in Vancouver, which I think is, in terms of market value, a disproportionate stock of the market value of housing in this country, things are very slow. And I just think it's going to be really difficult for the Bank of Canada to hike rates into that kind of a slow housing environment. If I'm missing something, then everything else is in line for them to hike rates. So, my view that the risk is that they're going to cut rates again this year is 100% driven on housing. And if I'm wrong on that, then actually I think hikes are in play.
Okay. So, I agree that that's the risk. I don't agree why that's the risk. But there was an article on Bloomberg today that said new Toronto condo sales were the lowest since 1991, I think. So, but that's the last time housing was really in the dumps, and just a super weak market was all the way back then.
What did the bank do in 91?
Well, they had just instituted inflation targeting, and so it was a far more complicated time than now. They jacked up rates into that to push inflation down. And then that enabled them to cut rates later. But at a different time, you had a challenging period in the late 80s. Real estate also that kind of was the start of the downturn. And in the 90s, real estate did pretty much nothing. Not my wheelhouse necessarily, but that's from what I can remember off the top of my head, that's pretty much the way it's gone. For now, whoever messaged you was right. Quebec is the real estate issues are localized to, I mean, local, not that local, but like Ontario and BC rather than Toronto and Vancouver, I would say. It's a little broader than that. But you're seeing everyone else level out too, and things are softening generally. The housing market is soft. And it's fair to say that, like, if the bank were to hike in this environment, that would crush a lot of that people in the housing market even more than who are already crushed or being crushed as we speak. So that's pretty valid.
I would argue if you see, and I know condo development, for example, in the city of Toronto or city of Vancouver is only responsible directly for a very small share of the overall labor market. But if you're in the lowest sales number in 35 years, you're not hiring anybody.
No.
And you're probably trying not to lay people off. And in the end, I think that is one of the more cyclical sectors where when you start to get layoffs there, that has a knock-on effect everywhere. And put aside the fact that you don't have the same kind of wealth effect that has been, I think, helpful for consumption. Although in Canada, you have the stock market on a tear, so maybe that's enough to offset it. And it is the point. It's never easy, right? You know, I think it's seldom that we have nobody that has a view on, you know, which way this thing is going to break. But it's not easy just to call. There's always conflicting factors. And so I say it because, to me, if you start to lose meaningful jobs in residential construction, again, I don't see how you can't. And so that, I think, is going to make it very difficult for the bank to hike rates.
Yeah, that's fair. I'm with you. And the reason I think they're kind of skewed to cuts potentially, inflation did slow. Like, the core numbers were weaker. If you get 3 more months of that and the 6 month is below 2% or lower, the 6 month annualized on the cores is below 2%, or let's say at or lower for those 3 months, because we're pretty much there now, or 4 months, let's say, that's a pretty good trend. It's not 1 month, it's not 2, like you're 3 to 4. That is more meaningful for me. And I still think the risks for the economy are to the downside, just generally. The Business Outlook survey had increased intentions for layoffs. I think that has the potential to drive kind of a negative feedback loop, as you mentioned, like even on the construction side. When someone loses their job, then they spend less money and so on and so forth, and that can drive more weakness. So I think that's still where the risks are until we get some kind of resolution on trade on the USMCA. And then things flip entirely on their head. Everything changes completely, totally, absolutely. We get a deal, assuming it's not devastating for Canada, which I guess it could be, but I don't know why we'd make that kind of deal. Probably no deal or non-devastating deal is the way to look at it. But if we get one, confidence comes back. Like, you know where things are going. Businesses will probably, there's a lot of pent-up investment to go, pent-up hiring. And so there's probably a pretty decent burst of growth. And that'll change things. And then 4 to 6 months later, you see all that data. And it's like, oh, look, maybe we can hike now. And the bank will look at the output gap. And the past few cycles, when the range for the output gap has had a 0 in it, so if it's like now it's -0.5 to -1.5, if that goes to -1 to 0 and 0's in the range, they have tended to start looking at raising rates at that point. So it's not that far from here when you're only half a percentage point. It's kind of a couple quarters of decent growth. So we'll see where we are. I sympathize with your view to some extent. The housing thing, it does matter. I probably don't pay as much attention as I should to it because I think it's actually good for society, but that's me.
Well, I think there's a paper I pointed to. It's called Housing is the Business Cycle. And the thinking is just, it's a cyclical sector and it drives everything else. It leads everything else. And so, yeah, I mean, we'll see. I guess if I were to try to articulate the bullish case for growth, I would start by saying that...
Is there one?
I think so, yeah.
Okay.
I mean... Turbo shared a chart that Doug Porter put together on gold exports. And it seems like a trivial thing, but gold exports are now the second largest export in this country.
It's making it really hard to forecast exports when gold is doing that.
Yeah, and of course, I mean, it's silly because the price of gold could drop 50% tomorrow. But so long as commodities are strong, maybe then you're replacing the lost income from housing nationally. And as someone who has, my family will disown me for saying this, but probably would not have voted Liberal, let's say, this government's been, I think, refreshing, terrific improvement from the last one, and much more pro-business. I think we all know as Canadians the potential this country has. And so if that starts to get tapped, then the sky's the limit. I think some of these projects are very long-term projects, and it's hard for me to see that kind of hitting growth in the next 6 to 12 months. But maybe that's the bull case, is that we have a bit of a commodity boom. We have more supportive government in that regard, gets people spending. You have people maybe moving from some of the hurt sectors on the trade side to some of the sectors that are doing a little better. I could see all those things. I just don't see it in the next 6 to 12 months. I think in the next 6 to 12 months, it's kind of sewn up. But if I'm wrong, I think that's how I'll be wrong. And so, that's kind of how I'm thinking about the two-sided nature of it. But Mike, I have a question for you, as I sometimes do. What's the most out of consensus view you can think of that you think has a better probability than what the market's assigning to it?
Well, we're pricing in 0 rate cuts pretty much, so that's probably the easiest one. That's the lowest hanging fruit there. That things kind of go pear-shaped a little bit, which I don't think is a real stretch. I don't mind your optimistic case. I don't mind that bull case. I think I actually agree. I hope the commodity side can really spark things. I don't know if it is enough to do it. Like, energy used to be enough, but that's no longer kind of a sector that sees big expansion anymore. But I feel like metals are an area where we could do a lot better, do a lot more. Yeah. Just generally. So hopefully you're right there. And on the federal infrastructure side, that's the other. And I agree, it's going to take time, but you never know. If they can really push hard on these things, maybe they can get them done a little bit sooner. That'd be great. But I don't know.
Yeah. No, fair. And I think I come back to what I said at the beginning. I just think that's the consensus for now. And I think sometimes these vol moments cluster where high vol tends to lead to high vol and low vol. And so it may be that we're in a really low vol regime and there isn't a lot to trade. I mean, those of us that have been in the market for a long time remember 2011 to 2016 was a dreadful time for rates trading. And we're heading back to that. I think we've been fortunate to have the kind of volatility we've had to keep things interesting for us. And we're going to go back to a different world. It doesn't feel that way to me, frankly. Like, no, I think, I think there's plenty of things out there that could come along and cause the regime to change.
So let's move on from the bank and from Canada, and let's go there. Let's go to the spicy start to the year. So we have President Trump making all sorts of headlines, threatening Greenland with invasion, and then not, or kind of with invasion. I guess nothing. So whatever short of that. You'll see, whatever that means, and then backing off entirely, completely, and then you have Japan's bond market meltdown, and then on kind of the equity side, which has taken up a lot of oxygen, the Mag 7 have kind of stalled out here. The market's still doing okay, but not led by tech in the same way that it was, I guess, previously. What's the most important one to watch? And I guess it depends on the market, but what are you focused on?
Well, there's two things. There's making money day to day and trading day to day, and the bigger picture understanding of how our world's changing. And I think on the latter point, it does seem like we're going into a period of deglobalization. I understand that's not a unique view. I think a lot of people hold that view, but it has implications for capital flows, which I think are important. And it was interesting, just anecdotally, hearing from our U.S. desk about how one little pension, or the Treasury Secretary, about how one pension fund in Denmark selling treasuries isn't a big development. But the truth is, the U.S. has been running major current account deficits forever, which has required them to have capital account surpluses, which essentially means they need the rest of the world to buy their assets. And so to the extent that the Trump administration tries to shrink the trade deficit, then I guess in turn they'll shrink the capital deficit. But it means, in my mind, capital flows there'll just be less trade and less capital flows. And so things become more about financing or having all your capital flows internal. So, Japan, who's been a major buyer of treasuries for probably at least the last 25 years, maybe they're not going to be buyers of treasuries anymore. Maybe in the end, they're going to let their treasuries roll off. And I think it probably speaks to a poorer world, which is, I think, globalization, although having winners and losers was a good thing. I think it's probably maybe a little less open, maybe a little more violent world. I don't know. But understanding those flows makes sense to me. And I think in the end, I'm not sure the U.S. is going to come out a big winner of this one. It's laudable to try to say they want to be able to manufacture more things there. And I can totally understand why you wouldn't want your military industrial base outside of the country, especially maybe in a country which you think you may have a conflict with. But for us, I think understanding how those flows develop is going to be really important, because here's one, and not to get too far into politics because there's no winning when you do that, but maybe if people take the change in tone from the administration seriously, they say, okay, we're Canadian Pension XYZ or Canadian Money Manager. Why do we own these treasuries again? Like, maybe we don't really need to own these. Maybe it becomes a political imperative to say, we will accept a lower yield on these because we don't want to finance a government we think is hostile towards us. I really, really don't think we're quite there yet, but I do think those sort of calculations will kind of start to come into effect.
Europe seemed closer.
Yeah.
Like this week they seem pretty close.
Yeah, like I think they're serious. And so who are the winners and losers in that environment?
Everyone loses.
Yeah, I think in the end everybody loses. And so maybe, okay, who are the people that lose the least? And so in Canada, I can't say that we've really seen that kind of a flow, but I think a lot of people do look and think that, maybe the Canadian dollar will do well by that, because it's pretty well known that a lot of the big money in Canada has invested a lot outside of Canada. And so maybe there'll become a political imperative to bring some of that money back. I don't know how you trade that. I think I could see a situation where treasuries do really well versus Canada for 6 months. But structurally, I do kind of feel politically that's where we're going, at least for the time being. And maybe the Supreme Court rules against the Trump administration and the president gets, crushed in the midterms and we go back to the way things were. But there is a certain sense that I think a lot of people have, which is the world is kind of changing in that way. So
that's what Prime Minister Carney told us, and don't agree with everything he says, but I think the broad strokes there were probably right on. I mean, the picture you painted tells me that Canada probably does okay. I mean, you have lots of different spheres competing for resources. Canada has resources that should benefit Canada if we play our cards properly, I would think. Better TSX performance, perhaps, for a change after underperforming for a very long time against the S&P, at least. Yeah, and then there's AI and what that does to us, and I don't know, all the doomsayers or those people who just say buy all the tech stocks and you'll just get rich. That I think is a different, challenging question for us. Do you have? I have a very specific thought there that might be out of consensus a little bit. But I think it makes so much sense that maybe I haven't heard it yet from anyone else. So, but you have all this valuation, wealth, market cap, whatever you want to call it, in these very specific companies. And if AI does help productivity for everybody, shouldn't that value be attributed pretty much across the board? Like, if everybody is more productive, all firms are better off. Shouldn't all firms be worth more, not just NVIDIA worth whatever it's worth, and pick a different tech firm? It doesn't really matter. They're just the headline grabber, but there's a bunch of them. Shouldn't everyone be better off? And maybe everyone will be, and they'll also be worth that, and they'll make the chips forever, and that's great. But shouldn't we all be better off?
Yeah, I think...
and that's like a bull case for all assets. That's a bull case
for everything.
Yeah.
I think it's just a bull case for civilization, that our problems are solved or improved. And I just don't think I'm the right person to opine on that.
But I know you have an opinion, so I think you are the right person.
Well, we'll see. I think that for me, the question is just a matter of how much does it cost to implement all the wonderful things AI can do. And I think there are people that will tell you they know the answer, although a lot of them are in a place to benefit from it, or promoting AI stocks. But that's the big question. Like, this is a different revolution than, the invent of software companies that could make infinite amounts of money without having to actually spend any CapEx. This is a real CapEx spend, and we'll see if we get a return from it. If we do, then I guess in theory that could be terrific.
And I guess the CapEx you mean is chips and energy?
Yeah, and the data centers.
Yeah.
It may be that we find out that actually, like, it just doesn't make sense. It just costs too much for, the technology. I think there are people that contend that we're kind of at the limit already of what these large language models can do. So, and it just doesn't make sense. The trade-off doesn't make sense. But I don't have a view on that. I think we'll see how it plays out. Anytime people stand to benefit from promoting something as a good, I'm a little skeptical, but doesn't mean I'm right on that at all.
All right, fair enough. I'm upbeat. I don't know. Technology has always kind of been the way forward.
Yeah.
This seems to me like it will improve my product. It already has improved my productivity.
It's amazing. It's
not
amazing.
Not a lot, because I'm not great at using it yet. I'm not consistent enough, but it answers questions that I want answered in a way that saves me a lot of time.
I agree with that, and I think, one of the downfalls of the trading seat is you don't have time to sit down and do the research you like. But I understand that it is kind of starting to show up in hiring in the more junior roles.
Yep.
Because it is amazing technology, and so even depending on what the cost trade-off is, maybe it is cheaper than having a junior analyst.
Yes, that kind of thing is I think where it makes a big difference, and I look forward to using it a little bit in a more effective way. But it helps, and it gets me information that I maybe would take a lot longer to get otherwise, and I know it helps. Santo works for me, helps him program stuff, and so it is helpful. And at the end of the day, I still think it leads to more jobs than it eliminates, and that's the way technology's kind of always been. And so the job fears, I'm super skeptical of. I'm just not that guy. History tells me that that's not the truth, and something, whatever it is, will make new jobs. I have no idea what they'll be. That part I don't know, but we'll figure something out and create new jobs for everybody.
May I ask, one of the things on my mind that makes me feel we are not going to get hikes this year in Canada is just, where does inflation come from? In your mind, where does inflation come from?
So the global picture that you painted is inflationary to me. You have way less, the economies of scale kind of go away when you don't have one competitive advantage, absolute advantage on trade, and just from a production perspective for mines and stuff like that, when everyone needs their own copper mine or their own oil field or their own whatever, and goods are not as fungible as they once were, that raises the cost for everybody. And then on top of that, you have kind of military spending and all that kind of stuff also raises the cost for everybody because everyone's going to be doing more. But is that a next 6 month thing? Probably not. So I can very much believe that, and this is what the bank's models have been telling them. You have an output gap, inflation's going to come down. Maybe that's what we're seeing now. That output gap's been there for 2 years, give or take, and it hasn't really come down yet, but it's kind of slowly drifted lower. Maybe we're at the point where, it is having that much of an impact domestically, and the inflation psyche, maybe to some extent, has been broken. And companies are not as willing to push prices higher because people aren't as willing to just spend because their house is worth less or whatever it may be, or they're more afraid of losing their job because the economy is not in great shape. So I don't see where you get a near-term real big pickup in inflation. The big issues in Canada were shelter. That's now come way down. It's a 2% and will continue to slow, I think. The real one area where there's a problem is still food prices. They are as high. I think they've risen faster here than almost anywhere else, at least in the developed world. And that's a serious issue. So that's one thing that I'm concerned about, but that's one category. All the other categories in the December print were pretty tame. So nowhere.
So when I think about this world, I still like steepening in the long end. It's had a decent move, but I think the curve can go steeper still. A few reasons. Part of the case for inflation is predicated on more government spending, and I just don't see them issuing a lot less in the long end. And in Canada in particular, having BC specifically choose a bigger program, that has been a lot more long supply, just straight up. And I think we just aren't seeing the same kind of demand for long bonds that we did in the initial kind of move higher in rates. Again, it just becomes very difficult to go to your boss and explain why you're long all these CAD long bonds that don't yield as much as long JGBs yield. So the idea that you're going to get a lot of foreign demand when in that kind of world, it just isn't going to happen. And so set against what I think the economy will probably do in the next 6 months, I think that has further to go, and I think it could probably work in a few different ways for you. Against it, maybe you could argue 5s, 10s is a little steep. There are varying views on this, but if you really think, we're mispricing that kind of terminal rate and that, actually they are going to cut rates back to 1%, let's say, then 10s at 3.5 or 3.40 maybe start to look kind of cheap, but it's still a world where they're going to issue a lot of long bonds. So that 10-year fly is something I think has had a bit of a move, but I think could probably go further. So that's something generally I kind of like, that I think we've tried to have on. And, I would change my mind on that. I think if you felt like they were going to do something to protect the long end, but, maybe the approach is like double the size of the 10s bonds as you have of the 5s, 10s. But the reason I think maybe you don't go with just the full bore steepener is repricing a terminal. Like it just a, hey, actually the overnight rate is going to end up at 1%, not 2.5%. And in that world, then 10s all of a sudden you start to say, wow, I'm getting quite a bit of carry here. Again, clearly set against my view that inflation is going to come down and that the economy is going to be weak. If you didn't think that, then I suppose 5s probably reprice a little higher. But
you brought that back to the market. That was very helpful. That was going to be my next question. Was be like, what trades do you like? But you beat me to the punch. I think that's anything else, or we'll leave it there for this week. Anything else top of mind?
I got request and a question.
Okay.
Which first?
Whichever one you want.
Okay, my question first then.
Okay.
Canada-US,
Yep.
30-year spread. Mm-hmm. Where do we think that thing is in 6 months?
6 months, Canada's probably... Oh, man, we're right around 100 now, 100,
yeah.
100 and a bit. 6 months. Is there a USMCA deal or not? Because that's what determines it for me.
Ooh.
If there's a deal, we are probably cheaper. Not a lot cheaper, but we probably are. I do think there's a limit. Like I think the rest of the curve is probably close to more or less where it should be. Like 50 to 75 beeps through, I'm okay with that. Like US grows better, higher inflation. Okay. Like that's about 50 to 75 basis points. And so for at 100 and change on longs, it could be a little more than that, probably just a little bit additional U.S. term premium.
Yeah.
But 100's a lot. I'd say like at 90, I'm kind of fully agnostic. At 103, we should probably, over the medium term of 6 months is not medium term, that's the problem, cheapen a little bit.
I don't know the answer to that one. Like I have to say, that's a tough one. If I had to pick, I'd probably go richer. Only because I just think they're issuing a lot of bonds there and they don't have a lot of friends right now. And so I think it's just a really politically easy thing now for somebody to say, I sold my treasuries, if you're a German money manager, because, we don't want to be seen to be supporting them at the moment. How much of that's in the price? Some, but maybe not enough.
I think we leak that way over time.
Yeah.
Like that.
If they weren't issuing so many, then I would say it doesn't matter. But I think, someone said to me, I can't believe stocks are up today. But if you look at the flow of funds, like they on the net are not really issuing any stocks.
Yes.
And they're issuing a lot of bonds. And so I think until that changes, they're just, there's not going to be a lot of demand for long bonds. And so at the margin, Canada's a little more fiscally responsible than the U.S., so I'll go with a little richer. But I'd have to concede minus 100 is not like a really exciting level.
All right.
My request is, can we call the pod "Remember Who Your Friends Are"?
Well, that's only thematic as to why you came on today. So.
And BMO's your friend. For anyone listening,
BMO is everybody's friend, and we are your friends, and we're always here to help. So. Jeff, you were here to help me today. Thank you. I know you're my friend. I appreciate it. Thanks for coming on. And now I'll have to have you on again relatively soon, because the best part about having Jeff on is he has views on a lot of global things that other people won't necessarily talk about, and he's very thoughtful about it. So I do enjoy having him on.
And if anyone else was in the room, you'd see Ben and I wearing the same vest. I don't think we're selling them, but we probably should sell them. They're very nice vests.
It's nice. Well, it's minus 25 out, so that's why we wear the indoor vests.
Yeah.
Thanks again, Jeff.
Thanks, Ben.
Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.